Talk Media Limited, where complex ideas are explained clearly. Hi, I'm TaxMax. Let's break down today's tax topic.
Floating a company doesn't just change who owns the shares, it can permanently change how those shares are taxed. A flotation is the process by which a private company becomes publicly traded by listing its shares on a recognized market. This often increases the value of existing shareholdings, which has direct tax consequences for shareholders and indirect consequences for the company itself. From a tax perspective, the key point is that flotation is not just a commercial event. It can fundamentally alter how shares are treated for capital gains tax, inheritance tax, and relief availability. On flotation, shareholders may sell some or all of their shares as part of the listing process. Any disposal triggers a chargeable gain based on the difference between the sale proceeds and the shareholder's base cost. Even where no shares are sold immediately, flotation often crystallizes latent gains by increasing market value, which becomes relevant for future disposals and inheritance tax planning. Careful planning before flotation can reduce tax exposure. This may include restructuring shareholdings, reviewing base cost and relief eligibility, considering the timing of disposals, and assessing whether reliefs such as business asset disposal relief may apply. Once the company is quoted, some reliefs may be restricted or lost, so pre-flotation planning is critical. Companies listed on the alternative investment market are not treated as quoted companies for many tax purposes. However, AM listing can still lead to a significant increase in share value. This means that while certain reliefs may remain available, the economic tax exposure of shareholders may still increase, and planning is still required. Flotation can also affect the company itself. The company may incur significant professional costs, and whether those costs are deductible depends on their nature and purpose. In addition, the company's future tax profile may change as it moves into a more regulated and transparent environment. Different groups face different issues on flotation. Founders may face large capital gains exposures. Employees may hold shares under approved or unapproved share schemes. External investors may focus on exit timing and relief availability. Each group needs to be analyzed separately from a tax perspective. Employee share schemes often become highly valuable on flotation. The tax treatment depends on the type of scheme, when shares were acquired, and whether income tax or capital gains tax applies on disposal. Incorrect structuring can lead to unexpected income tax and NIC liabilities. New investors acquiring shares on flotation are concerned with future tax treatment rather than historic gains. This includes future capital gains tax exposure, availability of reliefs, and the company's compliance history. Tax due diligence is therefore relevant not just for sellers, but also for buyers. In some cases, companies and shareholders may seek advance clearance from HMRC. Clearances do not guarantee a particular tax outcome, but they can provide comfort that HMRC accepts the legal and tax analysis underpinning the flotation structure. A flotation doesn't just change who owns a company, it can permanently change how those shares are taxed, which is why tax planning has to happen before the listing, not after. An IPO is where your shares finally become liquid, and so does your tax bill. Educational content only, not tax advice. Tax rules can change.
Educational content only, not advice. Rules can change. Thanks for watching. Clear explanations, one place, Talk Media.